This webinar highlights the volatility of capital markets in 2011 and 2012. The objective of this webinar is to summarize key global economic trends witnessed in 2011 and first half of 2012. Number 1. The global capital markets were very volatile and unstable in 2011. The key driver of volatility of global capital markets has been the European debt crisis. Greece has stayed on the verge of sovereign default, sending tremors to stock markets as well as fear of financial contagion to other European indebted countries, like, for example, Spain, Italy, Portugal, and Belgium. Number 3. Because of a protracted sovereign debt issues in Europe, the Eurozone has moved into recession and dampened growth of the Asian region too. Number 4. Treasuries and bonds continue to be safe haven of investments amidst economic uncertainties. This historic shift from stocks into bond markets happened despite very attractive valuations and strong earning potential of blue chip companies on the Wall Street. Number 5. The Canadian stock market index S&P TSX, anchored cyclically to commodities, oscillated more sharply than its American counterpart S&P 500 index. Commodity prices fluctuated sharply in 2011, with gold index declining by 17.3% and oil and gas retreating by 20.3% on Toronto Stock Exchange. Correction in gold was expected in 2011 due to its previous overvaluation by the market. Number 6. The emerging market index MSCI declined by 14.9% in 2011, with European sovereign debt crisis as major impediment of growth. Number 7. The Japanese economy stayed very fragile in 2011, wrought primarily by a devastating earthquake. Coming to 2012, which is point number 8, the European debt crisis is much more complicated than it looks. Any potential deterioration due to procrastination by the European policymakers can unleash a catastrophic wave in the European and global banking system, thereby jeopardizing the prospects of global economic recovery. Number 9. If the European Central Bank and the IMF can control the European debt crisis, this would potentially magnify the attractive profit margins for investors cashing on the already low stock valuations on the Wall Street. Number 10. The Asian economic growth will moderate in BRIC, Brazil, Russia, India, and China, keeping commodities prices, in particular oil and gas, under control. The probability of disinflation in commodity prices is high because of relatively controlled BRIC inflation. Number 4. The interest rates will stay depressed on the US and elsewhere, mainly on account of European uncertainty and moderate growth prospects in the US. Both the US unemployment rate and European debt crisis will continue to mask the 2012 economic scene and beyond, an impetus for policymakers to keep the interest rate lows at least in the foreseeable future.